My name is Michael Guyed, publisher of the Lead Lag Report. Joining us for the hour here is Lindsey Bell, who I know a lot of you have seen in the media over the last several years, and who was also a fantastic contributor to TheStreet.com here. But Lindsey, for those who are not familiar with your background, talk about who you are, how'd you get involved in markets, and what are you doing now?
Sure. So I've been following the markets for, I don't know, getting close to 20 years, but I look younger than that, I think. No, I started my career in investment banking, got into equity research, worked with Jim Cramer at the Street for a little while, helping to manage his small and mid cap portfolios before getting into investment strategy at S&P, working very closely with Sam Stovall, who I'm sure many of you are very familiar with. He's a good friend of mine. And then from there, I ended up at CFRA Research because they bought S&P's research business. And now I work at Ally, where I am the chief markets and money strategist. I joined there about 3 years ago to help educate our retail customers on the Ally Invest brokerage business. So I put weekly commentary out about what's happening in the markets and really just kind of ideas for our consumer or for our customers to think about as they're getting started investing. Our target audience really is that millennial higher affluent type of customer. And so that's who I'm talking to on a regular basis. Earlier this year, I took on the added responsibility of kind of covering some of the personal finance based topics as well too. So I've got a full plate and I'm a CNBC contributor too. So like Mike said, you will find me there often.
All right, so you and I both know what managing a portfolio means, because you mentioned you did that with Kramer on the small mid-cap size, but I want you to talk to the audience here about what exactly is involved in managing a portfolio from that experience with Kramer. What is it that you were doing? What does management of a portfolio actually mean?
Yeah, so the way that we managed our portfolios is we started with the top down approach where we looked at the various sectors and then the industries where we thought there might be opportunity. And from there, then dug in and tried to find individual securities that really offered value for the growth and the profitability that they were providing. So we would look at that and we would compare it, our benchmark depending on which fund it was either the small cap index or the mid cap index, the S&P 600. And so that's kind of like how we went about it. Is we started with that top down approach, and then we would dig in and kind of do our screening for individual securities, really learn the stories of the companies that we found interesting based on different numbers, whether it was their future growth rates, their PE, where they've been versus history, margins where they are versus history, and where the projections are based on street estimates. And then we kind of took it from there to find opportunities. But at the same time, you have to look at the portfolio, as from a holistic view too. So we were making sure, we knew which sectors we wanted to be overweight or underweight or didn't want to have any exposure to. So we took all that into consideration as well.
Do you find that stock picking since then has gotten harder or easier? And I ask that question because as much as everyone rails against, Kramer and individual stock ideas that different gurus of the moment might talk about, the reality is the vast majority of stocks really haven't had any meaningful momentum outside of really mega cap, large caps, right? And one way to kind of visualize that, if you look at small caps relative to large caps, that ratio is back to 2002 levels, meaning that if in '02 you were deciding whether to be in the S&P or in the Russell 2000, yeah, you had periods where you had outperformance in small caps, but from '02 to today, you really haven't done all that much despite the so-called small cap, mid cap, premium anomaly, which obviously hasn't really existed. So talk about how stock picking maybe has gotten either easier or harder over the last decade or so.
Yeah, I definitely think it's gotten a lot more difficult because it's, especially over the last decade, you have seen that pocket of the tech sector, the momentum, the growth sectors have really been leading the charge. And if you weren't in those, it was really hard to kind of beat the index. So where are you going to find that unique opportunity outside of what everybody else was piling into? So I do think that got a lot more difficult. Asset classes, a lot of stocks got much more correlated than they had been in the past. But again, there was the, those that were leading the market versus those that were lagging the market. But the leaders were so far ahead that it didn't matter if you thought you found this diamond in the rough. You might get good performance there, but is it going to be as great as some of the other things that you've seen? And I think what we've seen actually at Ally Invest too over the course of the last 3 years since the start of the pandemic is there was this really increased interest in stock picking, stock investing in general. And we saw a lot of newbies jump into the market, which was really, really great to see. People were trying to take control of their financial situation. They had a little extra cash because of stimulus, right? So it helped them get over that fear of investing. So they got in the market. They're really excited to buy individual stocks and securities. Of course, they were all leaning into the tech sector or the highest flyers, the Reddit type of stocks out there. But what we've seen since the start of this year is that you're starting to see some of that retail investor switch back into ETFs. And it's usually the, plain vanilla ETF. So you got the ones that are tracking the S&P 500. A lot of folks still like the Qs, the tech related indices as well, or the ETFs that follow those indices. And so you're seeing a shift back to that. Don't get me wrong, the bread and butter, or the majority of our business, I guess, is still individual stocks, but that bucket, the percentage of people buying ETFs versus stocks has increased. It's almost doubled from the end of last year, or the average, I guess you could say, over the prior 2 years following the pandemic to the beginning of this year too. So I think that's an interesting trend that we're starting to see. I think people are starting to realize that diversification is key because markets can move very quickly. While the tech sector was really hot for a decade or more, you saw that shift at the end of last year, right? As markets return significant market volatility returns, significant uncertainty returns, the benefits of diversification, I think, are becoming more apparent to investors.
What's interesting about this to me is that I think most advisors would lean on the idea, which is proven, that asset allocation is everything, right? That it's not about the individual securities in a portfolio. It's about the right averages, right? But individual retail investors, they love the stories that are told about individual stocks. I remember this advisor told me that he's a big believer in Brinson, Bauer, and Hood, that asset allocation is the key determinant of portfolio performance. But because he himself had individual retail clients that are not into investing the same way, he always wanted to sprinkle in some individual stock names just to have something to talk about, right? Because there's always something new to talk about on an individual company basis. I'm curious, in terms of, your role from the standpoint of educating investors on the Ally platform, how much of what you do is to try to get people maybe out of those stock specific narratives versus thinking about the broader picture? Because the reality is it's not based on opinion. Quantitatively, it really is about the school of fish, the argument of sector and asset class, as opposed to finding which one's going to be the at the front of the pack, so to speak.
Yeah, no, absolutely. Asset allocation is the most important part of performance for any portfolio. But individuals, they love the idea of owning stocks. And like you said, they fall in love with the story. But my job isn't to tell people not to invest in individual stocks, because again, that is what our customer base loves to do. My job is really to help them understand how to take a more holistic view of their investments and the way they're building their portfolio. And I think too, from a financial advisor perspective, or even if you're investing your money on your own, you don't have to only purely have individual stocks. Sometimes working with an advisor that can help you get that diversified portfolio, get the right asset allocation that fits your needs and your goals and your time frame and all those great things, and then being able to invest and dabble a little bit on the side. It's there to help satisfy that itch, or the level of risk that you want to have, or the fun that you want to have. To me, I can call that fun money, but you need to, I think, have the chunk the majority of your money really invested properly from an asset allocation perspective. And I think financial advisors are so important in that process. And I'll talk a lot about it because, the average size of our customers' portfolios with Ally Invest isn't significant. It's, probably a decent amount of their money. And we do have some very high net worth individuals that have a lot of money on our platform, but usually this usually is just a portion of their assets. And so I try to reiterate to them the importance of that balanced portfolio for the longer term. So I'll talk a lot about longer term trends and things like that. I think you saw I wrote about the 60-40 portfolio recently. I'll talk about active investing versus passive investing. And we at Ally too, by the way, are in the process of launching a wealth business too. We just hired some financial advisors, and we are in the mode where just our Ally Bank customers and Ally Invest customers can be customers of the wealth offering. But hopefully later this year, we will be launching it more widely. And so we do have that offering as well.
Have you seen, and again, I don't know how closely you're dealing maybe with the individual clients versus kind of more broader feedback, but have you seen that a lot of clients at Ally that are investing are asking more questions around energy because it's been such a high flyer, or commodities in general? And I say that only because I do wonder if you see a lot of people asking about investing in a space that's already done well, if that's a contrarian signal, because suddenly a lot of retail just wants to chase momentum. Talk about that dynamic a little bit, because I think that partially might explain why we saw such a breakdown in commodities the last couple of weeks here.
Yeah, no, what we do see is we'll see a shift in what they're investing in. And, I could tell you Apple and Tesla are always at the top of that list. But what we have seen a shift towards greater interest, at least in the earlier part of this year, we did see a greater interest in energy, and the retail investor, they tend to flock to whatever's hot at the time, right? With that money that they have in their individual brokerage accounts. So we have seen that. I can't say, at least in the top, I always look at the top 10 securities or ETFs that our customers are investing in. I haven't seen a lot of selling in any of the energy related ETFs or securities. It's been a lot of within the ETFs, just kind of back and forth between the Qs and the VOO, VTI, which is really popular. And ARC has been extremely popular all year on both the buy and sell side too. So you see them moving in and out of that with depending on where that's trending. So they are I'll say that the retail investor is very swayed by news headlines and momentum in markets one way or the other. But to your point, are you suggesting that the retail investor is moving the equity, the outflow that we've seen in especially like a material sector more recently? Is that what you're suggesting?
Well, or more just in terms of it is a contrarian signal, right? That if you see a lot of retail piling in after a big move in a particular theme, if that's sort of a sign that things might reverse, right? Sort of that argument that you usually see when it comes to technical analysis.
Yeah, and you know what? I haven't. That's an interesting. It's an interesting question. I haven't done a deep analysis on it, but I probably should look into it based on what our customers are doing, because I do think that would be very interesting. Because, like I said, they are swayed by headlines, but I don't know that they would be the right contrarian indicator. Because you always you hear the retail investors, the dumb money, right, out there, and so whatever they're doing is usually contrarian to what markets are going to do. And I don't know that that's, in the past, I've looked at that, and that's not always necessarily true. I think that retail investors that are in the markets are following it on a day-to-day basis. They're usually pretty on top of things. And I think that we don't give them credit for the knowledge or expertise that they do have. And I'm trying to dig it up. Because I've done research on it in the past. And what I've found is they're not as contrarian of an indicator as you would expect them to be just in broader moves within the market. They're actually usually pretty savvy. And one trend I will tell you that we have seen is that when the VIX spikes, and I think I can tell you this, is we see what we'll see on the bank side, our deposit customers, we'll see them take their money out of their deposit accounts and send it into brokerage accounts, whether it's Ally Invest or others out there that we can track that movement. And so the retail investor is very tuned into what's happening in the market, and they have historically been buying on big dips. I will say that the last couple months, I think there's been a bit of buying fatigue. I think there's been a little more fear than normal because, over the last in 2020 and 2021, right, it was always by the dip mentality. This year, we started out that way, but in the last couple months, the trend might be changing in the month of June. But in the last couple months, you've seen the retail investor sit on the sidelines, and I don't know if it's because they've lost enough money that they are not willing to risk anymore, or that they are, just kind of really uncertain about the future, and they're kind of sitting on the sidelines waiting to see when the bottom does happen to jump back in. With, like I said, the last couple weeks trends, we've seen people getting back in, like last week when with the Fed move and everything, when the market declined sharply, we saw people kind of jumping back in finally after a couple months hiatus. So they're smarter than we give them credit for. I will say that. So I'm not necessarily in the camp that they're a contrarian indicator in some of these, especially in the sectors.
Yeah, and in fairness, I don't like the term dumb money. Right? I know people use that term quite a bit. Right? No, because really what it is, I would argue it's not about being smart or dumb. It's about reacting versus thinking. Right. So system 1 versus system 2, kind of the Daniel Kahneman. And to your point that they're very headline driven and momentum driven, and it's about what's hot. That's reacting, right? Due diligence becomes a chart where it's going up and to the right, as opposed to a real deep dive on fundamentals. And I think that's where, when you see a lot of reacting, is often when I think you often have these kind of momentum crashes. And to your point about the buy the dip, that observation is interesting around when the VIX, gets elevated, they pull out of the deposits and then go into the brokerage account side. I suspect a lot of that, to your point, might abate only because the buy the dip mentality is entrenched because you have not had a prolonged period of weakness to change behavior. Whereas, right, I would argue that really this kind of bear market started February of 2021. That's when breadth peaked, and most individuals that are doing individual stocks probably lagged the broader equity markets that were just, mega cap tech heavy. But I think that's an interesting observation. Now, let's get into the name of the space here for a bit. The name of the space, from 60-40 crash to 60-40 melt up. So first of all, let's keep it very simple for the audience. A lot of people hear 60-40. I don't know if people really understand what 60-40 is. So first, define what 60-40 is, why it's typically sort of the baseline for asset allocation, and why it's usually worked, with the exception of this year.
Yeah, so the 60-40 portfolio, which you hear quoted all the time, especially in periods when it's not doing what it should be doing, is a portfolio that is 60% weighted in equities and 40% in fixed income. And usually when people are running numbers and doing analysis on it, they're looking at very basically for the 60%, at least, what I will look at is the S&P 500, and 40% for fixed income, looking at the Barclays Ag to really calculate how things are performing. And the reason people look at this portfolio, it's been around for a very long time. When you rebalance it every year, you got to make sure it's in that 60-40 allocation every year. It has given investors a really steady return for a really, really long time, 9% annual return from 1987 through 2021, for example. And so there can be down years though. And usually it's in those down years that you start to hear the voices growing louder that the portfolio is broken, it no longer works. The reason it's in the past has provided that really steady over a long period of time, a type of return, is because historically equities and bonds have been negatively correlated. In other words, they typically move in opposite directions. So if you are seeing a downtrend in stocks, that bigger portion of the portfolio, the 60% portion of the portfolio, you've usually got bonds to help at least soften the blow. And it's become a bigger bigger debate this year, I guess, because as you know, well, until recently, the bond portion of that portfolio has not been doing what it has historically done. But the other point I like to make about the 60-40 portfolio, Mike, is that 40% portion of the portfolio is exactly what I just said. It's there to kind of soften the blow, to be a cushion, to also provide, steady income as well. But it's not there for you to make a massive amount of money. That's not where you're going to make the money. It's really there more for protection than anything else.
And the causation is the critical point, right? Exactly. It's not just the correlation, it's the causation. And typically that 40% is not treasuries. It's not high yield. It's, high quality AAA kind of an aggregate bond proxy. You keep hearing this line that 60-40 is dead. And by the way, that's a line that I was saying, for maybe the last, maybe 8 months ago, 9 months ago, when it became clear that there was this risk of higher inflation, that the Fed was behind the curve, and all that's on Twitter and in different writings, right? But I think what surprised people, it certainly surprised me, in that it's never happened before in history from a quant perspective, is the sequence of the correlation, meaning that unlike in the 70s, even though stocks and bonds both did poorly in the 70s, in this year, the kind of correlation week to week to week has been unbelievable in the drawdown.
Yeah.
Right, where stocks collapse and bonds collapse. And it's really remarkable because if you were to look at aggregate bond, high quality bond funds, they've in some cases done a lot worse than junk debt because credit spreads haven't really widened. Right. I want you to talk about mean reversion in terms of 60-40, given that we've had such devastation of losses here in what is supposed to be not just the ballast to a portfolio, but also obviously sort of the way to generate income. You haven't really had enough income given inflation. It's less than the inflation rate. Oh, and by the way, your bond value has decreased to adjust for that inflation. So when you see what's happened with 60-40, does that make you think that this is one of those situations where people should be totally rethinking asset allocation? Or is this one of those periods where you'd say this is maybe a once in a generation asset allocation opportunity for 60-40?
Yeah, see, I'm in the latter camp, but I also believe too that 60-40 is a starting point for most people. Like that's just like where you should start your consideration for invest. I talked about earlier about having a diversified portfolio and how that's really important. That's exactly what this is a diversified portfolio for the most part. And, it's a really good starting point that works for most people. But if you're younger and you have a longer time frame and you can take on more risk, you can switch, you can adjust or shift the allocation. Again, same thing on the other end of the spectrum, right? So I don't think it's like the 60-40 is the end all be all. I think it's like a really, really good starting point. But I think when it comes to is it dead or not, the reason it really hasn't worked and it's really been, has had a significant underperformance is what you just talked about. It's this whole inflation narrative. It's what the Fed's doing. And yields have risen so fast this year. Like you said, even if you just look at some of the bond ags on their own, they've performed so poorly that it's kind of alarming, and it's waking people up to like the question is, is the environment that we're investing in structurally changing? And that's the question that you have to answer for yourself. And I think we're in the process of figuring that out, right? And what I mean by a structural change is this hot inflation that we're seeing now, is it going to be hot for the next 5 years, 10 years, like you saw in the 70s, 80s, or can it cool? Is it all, I think when you think about inflation, at least in the current period, it's driven by both demand and supply. And because of the demand side of it, you've got the Fed being extremely aggressive, and they seem to get more aggressive every day with where they want to take interest rates. And I think even when you look at some of the I guess smartest people on Wall Street, Goldman Sachs and whatnot, well, they're expecting inflation rates to come down a little bit in the months ahead from 8.6%, which is the hottest in 4 years. And I know everyone knows that at this point in time. They're still looking at inflation to end December at over 6%, which is still very, very high. So If you think the inflationary environment can continue to run really hot for the next 5 to 10 years, that's like a structural change, what we saw in the 70s and 80s. The question is, what can the Fed do with interest rates? That's going to change depending on what happens with the whole economic environment. They're very committed to pulling down inflation in the near term, which is why their rhetoric and their actions are getting more aggressive every day. But they're also doing that because if we do go into a recession, that they want to have the ability to fight that with interest rates by reducing them. And so it's one of the best tools they have that they can do that with. And so if you think that we're going to be in a high inflationary environment, a high interest rate environment for a very long time, then that's a structural change. And maybe the 60-40 portfolio is that. But if you think that either or both of those inputs or characteristics are going to change in the right way in the coming year, 2, maybe 3, then this might be a very weak period for this portfolio and as well as many other portfolios. So I hope that kind of answers the question.
No, and it's a topic that's kind of near and dear to me because that's been my hell. And in my case, from a tactical perspective, it's not bonds in the classic sense. It's really treasuries, which I would argue are a different kind of bond because usually during these flight to safety trades, they benefit. All right, you end up having high volatility in equities, yields drop on the long end. And I think you said it very well because you're right. The question everyone has to ask themselves is this the anomaly that we're living in the small sample in terms of this inflation, in terms of this behavior, or is it a structural change where longer term you have this dynamic where stocks and bonds keep acting the same because inflation remains extraordinarily elevated? Now, I would argue that I find it hard to believe that 60-40 is dead and that you can persist with this high inflation without something really severe happening from a societal perspective, because if you're going to argue that inflation structurally is going to be higher for many years to come, you're going to have riots, as we've seen in other parts of the globe. You're going to have people literally screaming about being able to pay for groceries. And that seems, given the high level of leverage in the system, like almost an end of the world type of bet. I don't know if that sounds a little bit too extreme, but just I want to hear your thoughts on what is it that you think? Do you think that this is more of an anomaly? Do you think that it's structural? What's sort of your own baseline?
My own baseline is that it's an anomaly. It's you look back, it's a period like I think it's more like a 2018. It might be probably a little worse than 2018 when we saw the bond tantrum. I just think it's an anomaly because my personal thinking is that inflation is going to come down at least, within the next year or 2. I think it's going to take a while. I think it's going to take a while for inflation to come down, but I do think that you're already seeing demand cooling. I think the bigger part of the equation is the supply side. You're starting to see some easing there. It's not happening nearly as fast as we'd like it to. China's reopening, so hopefully that adds a benefit to the supply side of things. But obviously the war in the Ukraine and commodity prices, well, I mean, we got a little bit of a relief this week, or more recently. But I think that there is still evidence that we can move away from these really hot inflationary prices and environment. But I do think that the consumer is reaching a tipping point. I really believe that in absorbing higher prices. They've still got cash on the sidelines, but they're changing what they're spending on, how they're spending, and how much they're spending. And as you know, as well as I know, it's inflation becomes a self-fulfilling prophecy. And I think we're getting closer and closer to that happening every day. So that worries me. But I still am in the camp that I believe that we can get between the Fed and other forces, we can get this under control, hopefully within the next year or 2. And I think, the Fed they're going to be aggressive in the near term. But I think once we get into the latter part of the year, if things start to change, as in inflation is moving steadily downward, even if it's slowly, I think that we can get to a point where the 60-40 portfolio, it might not be within the next 12 months, but I think it can come back and do well.
Let's get some of the audience up here. And everybody here, make sure you follow Lindsey Bell. You can tell very thoughtful in the way that she's approaching things and does some great work with Ally.
I don't think you're alone in your views when it comes to Jim Cramer. But what I will say is exactly what you just said at the end is I don't envy his position being on TV every single day and people hanging on to every single word that he says. I do think he gets a little bit of an unfair take because he's talking and thinking and analyzing in real time. And I don't think that if you look at his portfolios and what he's doing with I know he has the investment club with CNBC now, and that's the part of the business that I worked on at the Street, among other things. But, if you look at the portfolio performance, he does have a good track record. But I think when it comes to what he says and does and talks about on TV, it can be misconstrued. He doesn't get to clarify himself, and he doesn't get to, there's no one's really, I mean, I know there's like people out there doing it kind of, but it's just, he talks about so many different things that there's no, he says one thing and he doesn't necessarily have the chance to, in a week from today, I'm going to follow up on that, whether I'm still in or I'm still out type of thing. And so you don't always know where he's at. He might be in and out of something, and you just hear when he's in and a long time later when he's way out or something like that. So I think
and you also don't hear the waiting part, right, Lindsey? Like I feel like that's part of it. It's not just the entry and exit. In fairness, I'm not not to kind of berate on Cramer, but in fairness, you don't know the entry exit to your point, but you also don't know what the proper weighting or what he himself is weighting in a particular stock.
Exactly.
So if he's talking about a stock and he puts 0.5%. Right, then okay, it goes down 50%, fine, but that's only 25 basis points.
Right, exactly. So there's so much behind the scenes that nobody sees. So that's what I feel bad for him. But I also do think, like, to your point, he is the type of person that's just going to talk off the cuff. He's very passionate about investing in the markets and the economy and all this stuff. So you're going to hear like how he feels internally too. So there is like that level of emotion, I think, involved too. So, but again, in a very unenviable position, I would say.
So I would say it's enviable only because the guy is very wealthy.
Well,
but that's just me kind of arguing.
Can't disagree with that. I mean, I guess you could say the last 12 plus years have since the great financial crisis has been an anomaly, right? And maybe it has been, right, because the market's been up significantly since the great financial crisis, and
has had low volatility relative to history, and where U.S. was pretty much the only star. So yeah, I think that's probably accurate.
Yeah, exactly. And so I think that the market, there's always increased volatility around Fed changes in monetary policy. So what we're seeing now, I think, is absolutely normal. What we've seen in the past too is that when the Fed moves quickly, like they're doing now, and then they've done it that frequently, you do see the market react much more negatively. And so I think we got to see where we land on the other side of things. And that's like a big question mark, though. Of course, we're getting, the signs are pointing more and more to that hard landing. So again, it's going to be like, is the anomaly now where we're making that decision, or is it going to be on the other side of how they react to if we are in a hard landing position? So I think it's really hard to tell. I think that you don't invest solely based on what the Fed's doing. I think that the Fed has a major impact on how the market's going to react in a nearer term or shorter term type of period. But I think for the most part, most of us are out there investing for long-term goals. And so I think that is it's just like you don't invest for presidential cycles. You can, there's definitely a pattern to how the market moves in that 4-year cycle. Even during, like, we could talk about the midterm elections and how, people will point to history shows that after we get past the before a midterm election, the stock market usually underperforms and can be very volatile after that. After we get past that event, the market has historically moved higher and things have gotten less volatile. So I think that there's a lot of many periods of time that can be anomalies. I think it's better to look at, the bigger, longer term picture when it comes to investing. But you can trade around these things to the point of having that portion of your portfolio that is solely invested in individual securities or for fun or just to satisfy your own, having your own control over where you're putting your dollars in individual securities. But I don't think that we should be investing solely for exactly what the Fed's going to do in the next 12 months. You have to take it into consideration for sure. But also you have to take into consideration where you're at on your own timeline.
Yeah, and I'll add to that. It's challenging to make the argument that you should change your approach when you're living in what looks like a clear anomaly, because if you do that, it's really two decisions, right? You have to decide to change your approach based on the anomaly, but then you have to decide when the anomaly is over to revert back to the approach pre-anomaly. And that's a very, very difficult thing to do, right? And I think this is like, I get that feedback on my own approach from people, with hindsight, would you have changed anything? No, because I don't know with foresight where it ends.
Yeah, I think that's really, really fair. And that's the hardest part of investing is when you're in periods like we are right now, or a period that feels like an anomaly, you want to make the change. You're just like, you can't stand watching underperformance anymore. But usually it's on the other side of that the opposite happens. And so it's very difficult. And usually you don't have the guts to get back. If you get, like, example, if you just completely get out of the market, right, in a period like this when the market's already down, more than 20%, how do you know when to get back in? Like we just saw this past week, we saw a bounce in the market, right? So you're going to get back in at a higher price.
Yeah, it's always a fascinating decision tree to kind of think through. I want to turn that into a little bit of a question for Lindsey. So just on that point, let's talk about this kind of global inflation aspect, because there's an argument, Lindsey, that and I think this is largely true, and history will bear this out, that individual country central banks matter far less to the domestic economy than the Fed, because the Fed, you can argue, is the central bank to the world, right? Just given how advanced the U.S. financial system is. In terms of the ally investors and clients, is there, I assume there's a high degree of home bias, but is there some focus on international diversification? Is there some discussion around how inflation might be coming down outside the U.S. as maybe an investment opportunity? Talk through that dynamic a bit here.
Yeah, so our ally invest customers are very domestically focused, and they're primarily stock focused as well too. You see them buying less into, it's a very small slice of our business that buys into bond funds or ETFs even. So they're all very, very domestically focused. And so that's usually where I focus my narrative. Of course, I'm looking at what's going on around the world. And I totally agree that the Fed has a major impact on central banks around the world as well. And I agree with point that the Fed, they probably they're in a position where they can raise rates swiftly. Just given, first of all, it's very clear now that they are wherever you were at the beginning of the year, it's very clear now that they're behind the ball. They're behind the curve when it came to inflation for too long. And so now they're trying to make up time. But at the same time, even if we end the year with 6% inflation, that's still really high. It makes a difference in what the consumer is going to do. And it's going to make a difference in what the economy, how the economy can grow or contract. And so I think that's really going to be what the focus needs to be when it comes to Fed action. First, they want to tamp down inflation, but is it, it's fine to take some growth on the other side of that, but we have to, they're going to have to be careful navigating those waters, just because, if the U.S. is the largest economy in the world too, if we fall into a deep recession, the rest of the world is going to follow too. So, I mean, you have all of that happening.
Yeah. And let me say real quick on that. I give you a lot of credit because I think you're doing the right thing by joining conversations like this and wanting to self-educate. So I wish more and more people would, it's like this great quote from, I forget who it was. It's like, I'm not old enough to know everything. Right. So the fact that you're younger and wanting to self-educate and asking these questions, I give you a lot of credit. So Lindsey, go ahead on that. I just want to mention that.
No, I totally agree. Self-education is so important when it comes to investing and in this world. And because, everyone loves community, and that's why you saw Reddit blow up, and people want to talk to other people. And that to me is one of the most amazing things about what's happened over the last 2 years. People want to talk to each other about money and investing. But at the end of the day, you have to do your own homework, and you have to be comfortable with where you are putting your money. You have to know where your money is and what it's doing for you. When it comes to crypto, it's an asset class that I think is very interesting and intriguing. It's very volatile, like you just mentioned. This is just one of the volatile periods that crypto is going through. And so I think it's still in early stages of development. When you think about that, there's a lot of things that need to be taken into consideration about the future of where crypto goes from here. But I think for young people, or for anyone in general, if you want to dabble in crypto, I think that's totally fine. But I don't think it should be a significant portion of your portfolio. To me, 1 to 2% is plenty to have invested. If you think about the crypto market in general, it's significantly smaller than the stock market or the bond market. Okay, it's about like I think it was 2 trillion. I think it's a trillion now, where you've got over $100 trillion in the bond and stock market. So it's small potatoes, and so it should probably be small potatoes in your portfolio too. But I think it's an interesting asset class that we're all learning about it as we go too. So that's something to keep in mind as well. But good for you for getting invested in general. And what I would say is just diversification is key. Asset allocation, like Mike talked about, is really what drives performance of any portfolio. There's so much research and information out there, so just keep it up and keep doing what you're doing.
Yeah, and I would add that, just given that earlier point about correlation, that you could argue until the correlation and the causation breaks, that crypto is a part of the 60/40, right? Because it does largely move off of, at least the last several years, off of equity movement, right? So I think that's kind of this whole discussion around asset allocation is just a function of how big of a portion of the allocation should that be grouped under, so to speak. So I think that's a well articulated point.
My personal opinion is, I'm sure Mike, you have thoughts too, is that it's, at least when I look at the equity market, I do think that, there's different indicators that you can look at to reach extremes, to kind of give you that signal that, okay, the bottom is in the stock market and I can get comfortable with investing now. It's very, very hard to time when things bottom out. I think there's a lot of uncertainty left with what the Fed's going to do and where economic data goes from here, and if a recession happens this year or next year. And so I do think, there is a high possibility that the bottom is not yet in the stock market. Some of the indicators that I look at, while, like Mike, you mentioned the spread between, corporate and junk debt and treasuries, it's widening, but it's still not nowhere near extreme levels yet. You've got the VIX is having a hard time getting above 35. You've got put call ratios that have actually come down. You've got, but on the other hand, you have investor sentiment that's been extremely bearish for I don't even know how many months now, and you've just got some of these signals that have turned worse, but still aren't at extreme levels. So that, to me, that tells me that there still could be some downside before this is fully washed out. I think there's more cash on the sidelines now than there has been in a long time. I do think that. I just think we're in a period that's going to remain volatile, and I do think, despite this week's performance in the market, there could be more downside. The housing market, I'm not as familiar with the Canadian housing market, but I'd say here in the US, there's a lot of different interesting dynamics that, even though prices are going up and mortgage rates are going higher, and it makes it much less affordable to get into the housing market for individuals. You've got, the supply situation there, still very constrained. You've got outside institutional type investors getting into the market, and there's still a lot of people with cash that are buying. So the prices for home, even though you're starting to see sales numbers and volumes come down and housing starts cool off, I think sale prices have support, unfortunately, at least in the near term. And you saw that also in the shelter component of inflation recently too. That's moving higher, so rents are going up. So I think I don't see the housing market crashing anytime soon. I think the stock market has more to go. I think the crypto market is anyone's guess there. The bond market seems like it might be turning a corner. Maybe we've reached peak hawkishness from the Fed, and we can move in the opposite direction from here. I don't know, but I just don't. What I'm saying is I don't think the bottom's in yet, but I also don't know that we have significantly further to go lower, if that makes sense.
Yeah, and I'll add to that my whole thing the last 7-8 days about how there's a setup for this kind of melt up in both stocks and bonds, which may have started last week, is that's more of a sequence of returns trade, just given how certain everyone seems to be that the world is ending, sentiment wise. But I'm with you on that point, because I do believe that no matter what, from a longer term perspective, housing, as is historically the case with pretty much every single major recession, crash, correction, is going to be a really significant headwind, and not just in the U.S. but globally. You talk about Canada, Isher. I mean, you're obviously much closer to it, but I've seen and put out posts showing that when you look at Canada home values, it's just outright insane, far more than what we've seen in the U.S. And that's going to have its own kind of come to Jesus moment, right? Where that's going to come back in. There's going to be mean reversion, and that probably, to your point, Lindsey, means lower lows at some point, but it doesn't have to happen tomorrow. Right. I think that's sort of the key way to think about it. Any final thoughts, Lindsey, that you want to add as far as Ally, how people should track you?
Yeah, no, I would just say at the end of the day, follow me on Twitter at justlbell and lcbell. And if you want to receive my weekly commentary, I put a note out just about every Friday, and I've got my quarterly outlook coming out next week. Go to ally.com/do-it-right. Not the most intuitive website, but you go there, search for my name, and you can sign up to receive my weekly commentary.
Yeah, if you want to tweet that out, Lindsey, I'll retweet it. Thank everybody for joining. Special thanks to Lindsey, who was kind enough to not cancel given my own mess ups on the calendar. And,
no worries.
But everybody, thank you for joining, and thank you, Lindsey. Everybody, enjoy the rest of your day.